Good afternoon, everybody. It's Mike Cormick, also known as the Cincy Tax Coach, working under my new company, the Financial Clarity Group. Thanks for joining us today. This is the very first attempt at what I'm calling the Thriving Agent. If you can hear this, please shoot me a note in the chat or the Q&A. It should be I believe in the lower right-hand corner of your screen. I don't know exactly where it is on the viewing side. Just want to make sure that you're getting the audio. It looks good on our end. Turn the mic up just a little bit. Hopefully that's good. Well, I have 1 o'clock. Thank you for joining me. Today is the very first attempt at something I'm calling the Thriving Agent Q&A webinar series. My goal here is to provide some business building and income tax savings tips to you. We'll generally start the conversation with some topic that I dream up and think is applicable to your situation. A couple of housekeeping things. There is a way to send me questions, and after we do the initial part of the presentation, not even a presentation, a topic, if you will, I'm going to open it up to you. So you will be driving this conversation. Again, please shoot me a chat or a question just to let me know that you're getting the audio, and I'll be able to start the presentation. We do have people queuing up. We'll get into the bulk of what I was going to talk about in just a moment. Again, please send me a chat message so that I can make sure that you're actually hearing me. And you may even have already received a link to what I call the commission allocation template. It's a tool that I provide to agents to help them figure out how to allocate their commission between personal access or personal use, their business expenses, and income taxes. It's just a tool to use as a guide. You can edit it as you wish. Okay, I'm not getting any messages from anybody to let me know that we're good to go, but I'm going to assume that you can hear me and see me just fine. I'm sure the video is coming through. I can see that, but I just can't hear the audio. What I wanted to talk about, or at least get us started with, was a topic that keeps coming up. And there's a big misconception and misunderstanding when it comes to business entities. And specifically, I'm talking about corporations and LLCs. And before I dig very deep into that, I want to make sure that you know and understand that I'm not an attorney, and I don't play one on TV, and I don't play one on webinars. So what I'm going to talk about is very basic in nature, and to help you understand that it is something that I think you should explore, put it that way. In general, the misconception is that by forming an LLC or doing business under the LLC umbrella, you are doing something that will save you taxes or have an impact on your income tax liability. And I regularly get the question or hear the comment, well, I'm an LLC, so I'm saving taxes. The reality is that an LLC, while I think it's a good idea to do business under an LLC, the LLC formation, if you will, does not change or impact how you file your income tax return, and it doesn't save you any tax dollars with the initial formation. Okay, what forming an LLC does, and again, I'm not an attorney, but what it does is puts a legal barrier up, and I call it a chain link fence. So it's a legal barrier that is there to keep predators from getting to your personal assets. Now, I call it a chain link fence because it's porous, and if a predator wants to get in, they're going to get in. How successful they are is dependent on, one, your attorney, two, is how you operate that LLC or corporation once it's established. And the specifics around that are: one, it should have its own federal ID number. It should have its own bank account, and you should treat it as being a separate entity from yourself. What does that mean? Well, you shouldn't pay your mortgage from your LLC bank account. You shouldn't pay your child's high school education, private school, out of your LLC account. That's commingling funds. You should have a separate personal account to which you move money on a regular basis as a distribution from your LLC account to live off of. Your LLC bank account should be used to receive payments from, in your case, your broker, your commissions, either direct deposit or via check. I think most are direct deposit now. And then from that account, you should pay your business expenses, things like your E&O insurance, your meals, your business meals. And we'll talk about that a little bit in a little bit also. You should pay your marketing costs. You should reimburse yourself from that account for your mileage. The idea is to keep your business separate from your personal activity. And that's out of the box. That's all an LLC does, is it helps you separate your business activities from your personal activities. Beyond that, it gives us a foundation on which we can do some tax planning. And that's where the misconception or misunderstanding comes in. Out of the box, it doesn't change anything. But what it does is gives you a foundation on which you can then make changes as your business grows. So a new agent may establish an LLC and do business out of that for a period of time until such time they have enough income and revenue and need some additional complexity to start saving some tax dollars. That LLC then can elect to be taxed as either a C corporation, only as a C corporation, and then it could also, that C corporation can elect to be taxed as an S corporation. So it gives us a couple of levels or a couple of options to decide on how we want our LLC to be taxed in the future. Why would we make that decision? Well, because it gives us flexibility. Being taxed as a C corporation, for example, allows us to have the most liberal employee benefit options, from paying for health insurance to retirement plans, et cetera. Making the further step then to be an S corporation allows us to start saving self-employment tax on a portion of our income. It complicates some things, and that it complicates how we handle health insurance. We can still deduct it as a business expense, just we have to jump through a couple of extra hoops to get it done. That's the benefit of having the LLC in place. It gives us some flexibility to make changes as our business changes. I call it a malleable business entity. It's flexible. It gives us some options as our business grows. So that's the misconception, or the topic I wanted to start our conversation with. Business entities, I think they're great. I think more than likely having an LLC or multiple LLCs in your stable of entities is a great idea. Some additional questions that I've seen come through are meals and entertainment deductible. There's a big hubbub or misunderstanding right now about meals and entertainment expenses, and that comes into play for real estate agents especially. A couple of my colleagues have sent out emails and newsletters to their clients indicating that meals are not deductible. Business meals, and I disagree with that. I've read the code, and based on my reading of it, as long as it's not excessive or lavish, and it has a business purpose, you document it, who you're with, what you talked about, etc. It's still deductible to the same extent that it always has been. Now you're limited to 50% of the cost of the meal because the IRS still says you need to eat. So your portion theoretically is not deductible, but meals are still a deductible expense. Now, the second piece of that, though, is entertainment. So what has changed under the Trump tax rules is that entertainment costs are no longer deductible. And what's an entertainment cost? It might be your tickets to the Reds or the Bengals, or some of these folks are out of the greater Cincinnati area. So it might be tickets to your local sporting franchise, tickets to concerts, tickets to plays, any of those kinds of costs that you may have invested in are no longer deductible. So what does that mean? You can still pay for them through your business. You have to decide and weigh to what extent they're going to benefit your business. So if you spend $2,000 on a set of season tickets for the Bengals, you can't deduct that. You're going to pay tax on it. Is that still going to bring in $10,000, $20,000 worth of revenue from the customers that you take to attend those events? So there's a return on investment that's outside the tax realm. So you have to make that decision and move forward with that. Again, whether it's Bengals tickets, concert tickets, or whatever, you can still buy them through your entity, through your business. It's just a matter of not being able to deduct them on your tax return. Essentially, we add them back as income. If you have any questions about that, shoot me a question or a comment. The other question that keeps coming up is about specified service organizations. Under the Trump tax rules, there are some limitations on specified service entities with regard to the 20% business deduction. If you fall into that specified service organization, it's kind of like the old professional service corporation rules. If you're a doctor, a dentist, an accountant, or the majority of your business comes from the knowledge or skill of the business owner, then you have a separate set of criteria that you need to meet or follow. So there's a 20% business deduction that's available now, which means your net income, 20% of that is assumed to be a deduction, reduces your taxable income. Now, as your AGI goes up, you start to fall into a range where you may not get the full benefit of that. And it starts when if you're married, the married adjusted gross income is $315,000. If your taxable income exceeds that, then if you are not a specified service organization, you can still deduct the 20% business deduction. If you're a specified service organization, you are I'll say kneecapped. You're phased out. You don't get to take that deduction anymore, which is something that can be planned around. Okay, there are things that we can do either throughout the year or towards the end of the year to help you make sure that or attempt to get your AGI below those thresholds so that you can take full advantage of that deduction. What does that look like? Well, it might be a retirement plan. It might be an IRA. It might be finding a way to treat your medical expenses as a business deduction. It might be hiring your child to get some income out of your tax bracket or out of your tax return onto theirs. You can pay your child up to $12,000 this year and not pay any. Your child won't pay any income tax on that. That's because the standard deduction is now $12,000. I apologize. We have some construction going on. We're redoing a conference room here at the Far East office, as I call it. So I have a question. What's the difference between a C corporation or an S corporation? The underlying difference is that under state law, you can form a corporation or an LLC. A corporation limits the flexibility that you have, and out of the box, by default, you are a C corporation, which means that you're just a traditional corporation like P&G or GE or any other large company. The corporation, a C corporation, will pay its own tax. And now under the Trump tax rules, it's a flat 21%. It used to be that we had some graduated rates, and the low rate was 15% on the first $50,000 in net income. But now it's a flat 21%, which gives us some planning opportunities if we add a C corporation to our stable of entities and can change maybe how we operate a little bit and push some income to that C corporation. Most small businesses are not going to operate as a C corporation. An LLC, as I mentioned before, can elect to be taxed as a C corporation if it would like, and follow the exact same rules and have a flat 21% tax. Once the LLC elects to be taxed as a C corporation, or the C corporation on its own decides at some point that it can elect to be taxed as an S corporation. So it gives you, once you get to a certain level, they give you some of the same opportunities or options. It's just the LLC gives you some additional flexibility because down the road, it can reverse the process, whereas a C corporation can only go back to a C corporation. The S corporation does not pay federal income tax in most cases. The the net income from the S corporation is passed through to the shareholders. So in other words, if your S corporation's net income is $50,000, it gets reported on the S corporation tax return, but the S corporation doesn't pay tax on it. There's another document that gets reported to the shareholder. It's called a K-1, similar to a W-2 from your employer, in that the S corporation gives the shareholder a K-1 that reports their pro rata or percent of the net income. So if there are two 50-50 shareholders, there would be two K-1s. One, in my example before, the K-1s would report $25,000 in income on each of the shareholders' K-1s. Each of the shareholders would then report $25,000 in income on their personal income tax return and get taxed on the personal return. If they're husband and wife, that $50,000, the same $50,000 gets reported on their joint return, but they could file separate as well. Entities are kind of the foundation for tax planning. Depending on which entity that you're operating under, or which entity can be created, or how many entities and types of entities you have in your stable of entities, it will determine what options you have available from a tax planning perspective. As I mentioned, a C corporation has very liberal employee benefits. So the C corporation can pay health insurance. It can set up a medical expense reimbursement plan. It can set up virtually any kind of medical expense type program for its employees that is allowed to corporations. An S corporation, on the other hand, the health insurance essentially gets added to the shareholder employee's wages and then gets deducted on the personal income tax return. But you can't set up a medical expense reimbursement plan for the owner because they're specifically excluded from that type of benefit program. You just don't have the same type of options. Thanks for the question. Trying to send out this file for sharing. Hopefully it went out to everybody. It's the commission allocation template. If you have questions, just send them in the chat. My goal is to do this every Wednesday, or not every Wednesday, I'm sorry, the last Wednesday of each month. And again, we'll start with a topic. I'll generally bring the topic, and then we'll open it up for discussion. My goal again is to help you become a thriving agent, to help you become the best in your market. This is open to agents nationwide, so we will have comments and questions that come in from various states, and how that applies to your situation may be different. My suggestion is to always seek out the help of a professional. How a specific tax strategy is applied to your situation may be different or need to be adjusted for your situation or someone else's situation. Got another couple questions coming in here. Every time I go on a vacation trip, I usually negotiate a contract or two. I then can write off most or all the cost for the trip if I conduct business on this trip, correct? Well, the question doesn't specifically address it, but if you are out of town in Florida, in Orlando for some reason, and you are negotiating and working on a contract that's happening back in Ohio, I would say that's still not a business trip. That's still a personal trip. The visit to the mouse would still be a vacation. Now, let's change the facts a little bit. If you're in Orlando and you are a licensed agent in Orlando or in Florida, and you are party to a transaction in Florida while you're there, a portion of that trip should be able to be deducted as a business expense. Now, the issue is, why did you take the trip? So the overriding factor would be, did you go on the trip for personal reasons, or did you go on the trip to get down there to where this transaction was transpiring? If it was the latter, and you're down there for business specifically, then I would say all of the costs related to that trip are business related. Now, if you happen to go to Disney or you stay an extra day, those costs are personal and should be paid from your personal checkbook. But the travel down and back and the days that you're there for specifically for business are fully deductible. Now, if the trip is primarily personal, you're down there for vacation, and somehow you get roped into a transaction in Florida and you're licensed, then the cost of the trip down and the cost of the trip back would not be deductible. The cost of the portion of the trip while you're there could be a business expense. It gets kind of technical when you're talking about travel because so much of it depends on what the purpose of the trip was. If the trip is for business, it's very easy. Most of the trip, if not all of the trip, could be a business expense. Now, if you go on a trip to, for example, Las Vegas, and you're going to see or go to a training program put on by one of the various national real estate agent speakers, and so the primary purpose is to go be trained, then that trip would be fully deductible, going out and coming back. The time you're there, the meals that you're there would be limited to 50%. The hotel would be fully deductible. Your Uber costs to and from the facility where the program is being held would be deductible. Again, all of these costs should be paid out of your business bank account. And I'll go back to what I started to say earlier with the LLC. Regardless of whether you have an LLC or a corporation, you really should have a separate bank account for your business activity. That's almost business 101. And in my experience, it's unfortunate that the training programs to get agents certified and ready to become agents, they don't provide very much entrepreneurial or business specific business training to get people ready to be business owners, because you are a business owner when you get out of the program and become a real estate agent and have your license. So again, that's what I want to use this program for, is to help you become a better agent, to become a thriving agent, to improve your life, to improve the life of your family, to help you hang on to more of what you're making so that you can make a difference in your life and your community's life and that of your family. One of the things that I think is missing in most real estate agents' tax returns is saving something for retirement. Beyond saving for your income taxes, start putting something away for when you want to cut down and slow down. You're working in a profession where you can cut back and still remain active and still make a pretty nice living. But I really recommend that you start putting some of your assets away for when you want to cut back, so you can cut back without hampering your lifestyle. Hopefully we have some additional questions coming in. Again, my goal is to be available for you for about an hour once a month. We're going to try to do this on the last Wednesday of each month. There may be some scheduling conflicts that come up, and I'll try to reschedule for you. But in general, we'll do it on the last Wednesday of the month. I'd like to know what the right time is. 1 o'clock, that may not work for enough agents to make it worthwhile. So maybe we need to do it at 3 o'clock, or maybe we need to do it in the evening. And I'm willing to do that if there's enough interest. The goal is to be a resource for you. So let me know what you think is going to be a viable time for you as agents. We're going to be doing a tax planning presentation on July 11th that will be available for business owners, and you are business owners. As soon as details become more solidified, I'll send it on an email for you. Yes, these are recorded, and within a short period of time after we finish, you should get a link to a replay. It may be sometime in the future that we stop the replays or change how they're distributed. The goal again is to be able to impact as many agents as we can, so if a question is covered in one of these presentations, that will help someone, they can access it later. And we may use these in our own marketing as well. the part of the idea behind the Thriving Agent program is to potentially have a subscription-based model where someone has to subscribe to have access to these programs. It would probably be a relatively nominal fee, but to get started, I want to open this up to as many as possible. The more people that register now and participate in these webinars, they will be exempted from a fee in the future. I think it's worthwhile and can be a valid resource or valuable resource for agents to have access. Again, if you have any questions, let me know. If there aren't any more questions, we're going to wrap it up at about 1:30, and we will pick it up in another month. The next program will be scheduled for July 25th, it looks like. If you registered for this particular program, you will get an invitation and a reminder for the next session as well. I think I only scheduled them out through December to see what the participation rate was. If you happen to have a microphone and or a camera, I can bring you into the presentation to ask your question live as well. And if you'd like to do that, I think there's a button on the lower right part of your screen where there's a hand, and I think you can raise your hand and it will notify me that somebody wants to speak. I don't see any additional questions. Folks, again, I appreciate you attending the very first Thriving Agent Q&A webinar series. I look forward to, oh, we got a hand raised here. Let me see if I can bring him in. Nope, maybe not. Maybe he chickened out. No, I don't see it now. If you'd like, go ahead and try it again. I'll wait and raise your hand and we will bring you in if it's possible. You may want to try Google. It says the browser is incompatible. I've had the best luck with Google Chrome. It seems that it's the preferred browser. If it doesn't work, maybe we'll try again. He has a Surface away from the office. You can load Chrome on your Surface. It may be on there too. You may have to put the webinar URL in Chrome and reopen it. But if you do that, I'll bring you in. I'll hold on for a moment. Well, I appreciate that. It says the information's invaluable and more agents should make a point to do this webinar. Well, I appreciate that, Gary. And I think so too. I hope that this gains some traction and more agents will start to attend. I think part of the apprehension is they think it's going to be a sales pitch, and I'm going to do my best not to do that. I want to be a resource for agents and hopefully help them become thriving agents. It is Let's see, realtors in general don't work their business like a business. That's absolutely right. And unfortunately, a lot of entrepreneurs in not only real estate, but in other professions don't operate their business as a business either. And hopefully we can have an impact, at least on real estate agents. They think their broker will take care of this stuff. That's not true. We know that's not true. I met with a broker. A broker had me speak for their various offices last fall. And one of the common questions that they get is whether or not they're going to prepare the tax returns for their agents. And obviously that's not going to happen. That's not the broker's responsibility. The broker's responsibility is to facilitate the closings, collect the agent's fee, provide marketing services, and send a 1099 to you, their contractor, which means that you are your own business. It's not their responsibility to prepare your tax return or prepare your P&L, your profit and loss statement, or for that matter, keep track of your balance sheet. It's important that you know that you have to do that. And that's part of being a business owner. It's sometimes discouraging when we ask a business owner whether they've reconciled their business bank account. And yes, people still do that. And yes, it is important. It's important to know that you've recorded every transaction and that every transaction you recorded went through your bank, because in most cases you are cash basis. I'm not sure what that last comment was. It might be a typo. Again, the goal is to have an impact, to have real estate agents attend, learn something not only from me, but as we have other agents participate, maybe get them on the screen. There'll be some information and some sharing that can go on, and we can build a stronger community and help you build stronger businesses. It was an LOL, laughing out loud. Yeah. So it's 1:30. I didn't bring a lot of topics because obviously I want the conversation to be driven by you, the attendee, and the real estate agents. This is for you. I want you to bring your questions. We may not be able to solve everyone, and we may not be able to provide a solution that fits your exact situation, but we can maybe set you in the right direction and maybe put you in touch with someone, but if it's not us, that might be able to help you. If there aren't any other questions, I may have another one here. Hold on one second. Let's jump over here. I think we got those. And I think we got it covered. So that's 30 minutes in. I'm going to devote an hour to each webinar when we do it. If we only last 15 minutes, that's up to you guys. If we last the full hour, that's up to you guys as well. Again, this is Mike McCormick, the Cincy Tax Coach. My new company is Financial Clarity Group, and we have two offices, one in Blue Ash and one in Mount Carmel. I call it the Far East. If you need any help with your business, please give us a call. The number is 513-488-1121. And I look forward to meeting you and learning more about your businesses. Until next month, take care and go sell some real estate. Take care.